Good morning, everyone, and welcome to the June Mortgage Quality and Compliance webinar. This is Susan Milazzo with the California MBA, and I'm very happy that you could join us today. If you see the instructions on the screen to join the audio portion, you can click the audio tab and get the dial-in information. And if you have questions during the presentation or at the end, you can pose those in the questions dialog box that's in the lower right-hand corner of your panel on your right. So with that, I'd like to turn it over to Marty Allred with American Pacific Mortgage, who is our Mortgage Quality and Compliance Committee Chair. Marty, I'll turn it over to you.
Thank you, Susan. Hello, everyone. This is Marty Allred with American Pacific Mortgage Corporation, and I hope your June, first half of your year is going great. I'm sure if you're in a lender shop, it's the end of the month and it's crazy busy, and I can respect that. And thank you so much for taking the time to join our webinar today. Our main topic is going to be about internal audit requirements. So we're looking forward to what Michael Steer and Tara Pettersen have to tell us about internal audit requirements. Before we do that, though, we have our legislative update and litigation update. But before we even get to that, Susan actually has several events with California MBA that she wants to tell you about. So Susan, can you go over those?
Yeah, thank you. We do have some events coming up, not the least of which are major conferences, but mixed in there we have some networking events, so wanted to share those. We host a series of free networking events up and down the state, and anyone is welcome to join them. You just need to visit our website, cmba.com, click on the events tab, and you can see what is there and how to register. We do ask that you register so that we know that you're coming. We have one on July 10th at Lending QB, and that will be in Orange County. After that, later in the month, we have our big Western Secondary Market Conference happening in San Francisco. So that's always our signature event, and we're looking forward to a great one this year as well. In August, we have our Mortgage Technology and Servicing Conference happening in San Diego, and we've got some very exciting mortgage tech products that we're going to be featuring. So if you are able to join us, I can promise you that will be well worth your time. If you are with a member company, we are offering a half-off registration for your registration and your attendance. So I wanted to make that as a new member benefit this year so that we can showcase our technology products to a larger audience. And then lastly, we have on August 14th at the offices of Blend in San Francisco, we have another networking event. So 2 networking events, Northern and Southern California that you can check out, as well as our regular conference schedule. So hope that we will see you at any or all of those events this summer. Thanks, Marty.
Great. Thank you, Susan. Thanks so much for your team coordinating all those events. Lots of opportunity to network and get information about the industry. So thank you so much for the hard work that your team puts into those events. Okay, so we're going to go ahead and get started with our topics. Our California legislative update is brought to us by Pat Zenzala, California MBA lobbyist with KP Public Affairs, and I hear Pat's been very busy lately. Pat?
Yep, can you hear me? Hello?
Yes.
Yes. Oh, thank you, Marty. This is Pat Zenzala. I wanted to cover a couple of bills that I think are relevant for our industry. We're heading towards the legislative break. We have for the summer, but we have several policy and fiscal committee hearings happening on bills that are of interest to us. The first 2 bills that I want to talk about, AB 2063 and SB 1087, are PACE related, so they're property assessed clean energy program, and I think there are some challenges with these programs as far as impacts on borrowers, mortgage customers, and the ability for them to refi or to sell their home, and being faced with, in many cases, having to pay off the PACE loan before they can do those types of things. And so we've been working to try to create additional consumer protections and parameters around the ability for PACE products to be provided to consumers. And last year we passed a bill that helped in that regard, created statewide standards for the first time, and AB 2063 and SB 1087, the second bill I want to talk about, are following up on that bill and trying to enact additional protections, such as additional requirements as far as assessing the ability of the customer to be able to repay the loan, and then putting additional parameters around and restrictions around pay solicitors. In many cases, the home improvement contractor types that sell the energy efficiency products, and then also the financing for these products. So both of these bills will create additional protections. They're both in Appropriations Committee in the separate houses, Assembly and Senate. And at this point, the authors of these two bills are trying to align what's in them so that essentially likely one of these two bills will survive with all of the language in it, and the second one will likely not continue to move. From our perspective, we support both bills. We are in favor of additional protections out there. And the PACE administrators are strongly opposing both bills. And interestingly, one of the reasons that they're opposing both bills is they're arguing that their market volume has gone down dramatically in the first and second quarters, depending on which one you talk to, between 30 and 40%, and they're attributing it to all of the additional requirements that passed with AB 1284 last year, and they're saying that they don't want to see additional restrictions go in place. So that's interesting that that's what they're using, because I think the first and second quarter have been challenging just in general as far as mortgage generation. The third bill I want to talk about is SB 818. This one deals with reinstatement of provisions of the California Homeowner Bill of Rights that sunset at the end of last year. Essentially, those provisions applied to entities, mortgage servicers, and originators that had more than 175 or more foreclosures within the last 12-month period. This bill would actually reinstate those provisions. So even though they fell off the books at the end of 2017, and January 1st, 2019, they would go back into place. And this bill is being sponsored by consumer groups that believe those protections for foreclosure prevention should be back in statute. It appears that this bill is going to continue to move. What we were able to do recently, which I think has been helpful, will be helpful for the industry, is we were able to put some benefits or some positives in the process with respect to mortgage servicers, and that is we were able to put in a 5 business day time frame prior to sale. Foreclosure sale, where the person, the borrower would have to essentially apply for any modification or alternative foreclosure more than 5 business days prior to the sale. Today, effectively, they could try to apply up until the last moment. And so this brings it a little closer in line with what we're dealing with as far as national servicing standards. Also, we help to clarify and remove a conflict with the Fair Debt Collection Practices Act, whereas if a customer asks us in writing to stop contacting them as far as due diligence prior to beginning the foreclosure process, today we potentially could have issues between conflict with the Fair Debt Collection Practices Act and what's required in California statute as far as foreclosure prevention. And this, we put a provision in the bill that will say, hey, if a customer asks you, you've met the due diligence requirements essentially for the outreach that's required prior to dealing with, prior to starting the foreclosure process. And then the final bill I want to talk about today is AB 375. This is a relatively new bill as far as language that's in it, and it deals with privacy in California and restrictions on what you can and can't do with customer information. Essentially, this bill is being put forward as an alternative to a privacy initiative that just qualified for the November ballot. And that initiative, if it passes, would have pretty significant impact on industry ability to utilize and manage customer information, and it could have also a dramatic effect on the secondary market as far as the sale of mortgages. AB 375 is a last-minute proposal that essentially is more palatable, still has some very significant restrictions on the ability to utilize customer information. It provides customers with the ability to opt out of having information sold. It also provides some ability for them to ask for a business to delete their information. But generally, it's more balanced than the initiative would be, and it would offer an opportunity to essentially fix problem issues on a go-forward basis in the legislative process, whereas the initiative really does not. It would make it very difficult to make any changes. So it's very likely this bill will pass today in a very short process and go to the governor, and at this point we expect the governor to sign it. And it would take effect in 2020, so there would be some time to try to address any issues that are out there in the next legislative session. That's it, Susan. Sorry, it probably took a little longer than I wanted to, but some important issues that we're dealing with.
Right, and a lot of information, Pat. Thank you very much. And for those of you that are following the ballot initiative process, that ballot, the privacy initiative that had qualified for the November ballot would have been significantly more damaging to the mortgage industry than this bill. And Pat has been working tirelessly to represent the best interests of the real estate finance industry. And you've done just a fantastic job, Pat. Thank you very much.
Thank you. And Susan, by the way, just to connect the two dots, by the way, I didn't mention this. The privacy proponent for the initiative says that if this bill is signed today, he will drop the initiative, and today is the last day. So once again, very high stakes, and there's a lot going on, and so it would be good if this initiative is dropped.
Yeah, thank you. Great work.
Great. Thank you so much, Pat. Okay, so we're going to move over to our litigation update with Michael Pfeiffer with Kirby and McGuinn, and he was also General Counsel for the California MBA. Michael?
Thank you, Marty. Good morning, everybody. Mine's going to be fairly short, but I think most of you will find this interesting. This is a case that was basically decided last week, well, maybe the week before, but it was just last week, the 21st, I guess. Yeah, the 21st. And it was decided by the U.S. District Court in the Southern District of New York, which is in Manhattan, and it found the CFPB unconstitutional. The judge found the CFPB unconstitutional. And it was kind of a weird case the way it came up, but this is interesting. It's an interesting holding. Now, the holding it doesn't really bind. I'm not even sure if it binds other, judges in that district, but it's kind of a strange thing that this came out now after everybody's been watching the PHH case and constitutional holdings there, and the en banc decision by the by the Court of Appeals for the District of Columbia, where they upheld the constitutionality of the CFPB. Now that the CFPB is sort of under the control of the Trump administration, and a lot of the things that are being done there by Mick Mulvaney are being questioned by the consumer advocacy groups, the District Court of New York made this decision. Basically, this case involved, it was a case jointly brought by the CFPB and the Attorney General for the state of New York at the time, Eric Schneiderman. And they sued this, again, the facts on this are very interesting. They sued RD Legal Funding and other related entities, alleging that they had violated the Consumer Protection Act and the New York State equivalent, arising out of these activities of these RD entities in making cash advances for consumers waiting on payouts from settlement agreements or judgments. These payouts had to do with primarily the NFL concussion litigation. So you see kind of a confluence of a bunch of interesting public issues here. A lot of the claimants were, had been injured and they wanted their money now. and RD funding was giving them advances on these sort of things. The CFPB and Attorney General Schneiderman alleged that they had misled the consumers into entering into cash advance agreements, misrepresented them, and when in fact they were usurious loans. There was interest rates built into them. And the defendants moved to dismiss on numerous grounds. And one of those, and believe me, there were several of them, but one of them was the unconstitutionality of the CFPB. Next slide. Pardon my voice. After going through a lengthy analysis of the various issues, clear down at page 104 of her opinion, Judge Preska declined to follow the ruling in the PHH case about the en-banc panel, and instead adopted a dissent. And in that dissent, she acknowledged the opinion in PHH, but she said she's not bound by it in the Southern District of New York, and she didn't like, but so she adopted Judge Kavanaugh's ruling in the PHH case, except for the part where he tried to fix the problem with the constitutionality. Those of you may recall, they found it unconstitutional. The lower court, the district court at the District of Columbia found the three-judge panel found the CFPB to be unconstitutional, but they fixed it, or they thought they fixed it, by basically severing the clause having to do with the removal of the director. And she said, no, I'm not going to agree with that. Next slide. She said, and so she basically struck down Title 10 of Dodd-Frank in its entirety, which is like that. I mean, Title 10 is the linchpin upon which all the regulations and everything else of the CFPB have been issued, and also the UDAP authority. And she said that the CFPB had made an effort to ratify the suit after the fact, after the rulings in District of Columbia, and she said that doesn't cure the underlying constitutional deficiencies. I'd just like to read just a short paragraph from her opinion. It says, respectfully, the court disagrees with the holding of the en-banc court and instead adopts sections 1 through 4 of Judge Brett Kavanaugh's dissent, where, based on considerations of history, liberty, and presidential authority, Judge Kavanaugh concluded that the CFPB is unconstitutionally structured because it is an independent agency that exercises substantial executive power and is headed by a single director. And she disagrees with Section 5 of Judge Kavanaugh's opinion, where he determined to invalidate and sever the for-cause removal provision and hold that the director of the CFPB could be supervised, directed, and removed at will by the president. Instead, she says the court adopts Section 2 of Judge Karen LaCraft Henderson's dissent, wherein she opined the presumption of severability is rebutted. The severability clause does not give the court power to amend a statute, nor is it a license to cut out the heart of a statute. Because Section 5491C3 is at the heart of Title 10, I would strike Title 10 in its entirety. I don't know where this is all going to go. Obviously, this decision could be appealed. I don't know if the CFPB is going to appeal it under Mick Mulvaney. He's done a lot of things to basically disassemble the CFPB. But a lot of commentators are going, this brings up the issue from a legislative standpoint. Next slide. And so where it's going to go remains to be seen, but it's really the first case since the PHH where the constitutionality of the CFPB has been raised. It's 8 years. We're 8 years into the statute, and only now, other than the PHH case, only now are we dealing with this. So something to watch. I think what's going to happen is this is going to give fuel to the debates over restructuring the CFPB, And but we'll see if other courts adopt this holding. Marty, that's my report.
Great, thank you, Michael. It is certainly an interesting twist on the ongoing saga around the constitutionality of the CFPB and the debate surrounding that. So thank you for breaking that down for us. Appreciate all your work on that. Thank you, Michael. So we're going to move into our main topic today around internal audit, and we're very pleased to have guest speakers Michael Steer and Tara Pettersen. Michael Steer is the president of Mortgage Quality Management and Research, MQMR. And MQMR bridges the gap between risk and compliance, providing mortgage compliance consulting throughout the origination process, conducting internal audit risk assessments and ongoing internal audit support, servicing QC and subservicer oversight, warehouse due diligence, document custodian audits, and vendor management. So lots of various services provided by MQMR. And then Tara Pettersen is the Vice President of Risk Management for CMG Mortgage Inc., DBA CMG Financial. In this role, Tara oversees compliance, licensing, fraud, vendor management, quality control, external audit, and functionally oversees internal audit. Tara works closely with correspondent, wholesale, retail, and executive management to ensure compliance and mitigate risk. Again, very happy to have Michael and Tara with us today. Michael and Tara, take it away.
Perfect, thank you. So when I was first asked to present on internal audit, I wasn't sure which direction to go. I got to thinking and decided that I should just ask Siri. So I had a conversation with Siri and recorded it. I knew that if anyone knew what internal audit is, Siri would. So I'm going to play that conversation for you. Okay, Siri, what is internal audit?
Here's some information.
Please read.
Internal auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. Would you like to hear more?
Yes, please.
It helps an organization accomplish its objectives by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control and governance processes. Internal auditing is a catalyst for improving an organization's governance, risk management and management controls by providing insight and recommendations based on analyses and assessments of data and business processes.
Thank you, Siri.
My pleasure, as always.
All right, so that's Siri. I'll take a quick poll. Who likes to get body slammed by regulators and examiners? Being that no one can respond on this call since you're all on mute, I'll go ahead and assume that the answer is no one. And I'll assume that I'm sure a lot of you out there are giving me what I like to call a courtesy laugh. If you don't know what the courtesy laugh is, then I suggest you look it up in Urban Dictionary, or just like the presentation says, ask Alexa, Siri, Cortana, or Google. So now that we have your attention, let's get started. The objective of the webinar is to help provide some tips on what internal audit is, what's required, how it's different than QC, which is a common misperception in the market, some benefits of internal audit, and different ways to execute on developing a program that meets the GSE's vague guidelines. You'll get the perspective from an external internal auditor, MQMR, but also from Tara of CMG, who has built her internal audit department internally. So what is internal audit? Well, Siri just told us what it is, so we can conclude the presentation. Thank you very much. But really, internal audit identifies credit, regulatory, operational, financial, and reputational risks and any controls in place to mitigate those risks. An internal auditor looks at the process itself and independently evaluates the risks and control activities within the process. Internal auditing equals assurance, insight, and objectivity. Internal audit assists the company in meeting its risk management objectives. Plus, it's a requirement by the GSEs and various banking regulators.
Thank you, Michael. Internal audit also benefits mortgage lenders by identifying weaknesses before a regulator does. It improves processes, mitigates reputational risk, and ultimately will save the company money in way of fines and fees. Another cost saving is possible recommendation for streamlined processes which are identified during the audit process. Internal audit is not the same as quality control. Quality control is an agency requirement designed to ensure lenders are producing quality loans. QC identifies credit, compliance with agency guidelines, and regulatory compliance on a loan level basis. Internal audit, on the other hand, has a broader reach and will focus on all areas of lending activity, including human resource, payroll, accounting, marketing, compliance, comp, and even quality control, to name a few. Where quality control must be independent from credit, internal audit must be independent from all functions of a company, including your compliance department. Internal audit identifies a variety of items such as credit, regulatory, operational, financial, and reputational risk. An internal auditor looks at the process itself and independently evaluates the risk and control activities within the process. You may be thinking, so why can't I just do a one-time audit or outsource a company-wide audit? Internal audit focuses on a certain process and/or area of your company. Performing an overall company audit would be too broad and not offer benefit. Imagine one manager overseeing all areas of your company. Would they be able to identify all risks or properly oversee all areas? It's the same for internal audit. Addition of staff, management turnover, issues which arise during an external audit, employee identified risk, and regulatory change lead to a need for continuous auditing. I'm sure many of you are thinking now, okay, you guys have convinced me. I'll implement an internal audit team, but I'll just have my compliance officer perform the audit. Seems logical, but our compliance officer is involved in putting the process in place and managing the process. In this case, your compliance manager would be auditing him or herself. Compliance officers act in a management function and make management decisions. Internal audit must be independent. This does not mean an internal auditor cannot work for your company, but they must be independent, just be independent of all other areas and report directly to executive management or the board of directors. In my case, because I oversee other departments which will fall in the audit schedule, I functionally manage the employees, but the activities of the audit department report to the executive management team.
So why internal audit? Easy answer, because it's a requirement. Long answer, because it will make you a better organization. The GSEs and the CFPB have been generally vague in their written requirements for seller servicers and non-bank mortgage lenders as it relates to developing and maintaining an internal audit program. Up until recently, they've basically stated that you have to do it. In addition, there are states that are also somewhat vague. They ask during examinations to see internal audit reports or the audit schedule, but they do ask for a list of internal audits performed and if there were any significant findings. If a lender does not perform internal audit, oftentimes the state examiners may scrutinize more closely the lender's compliance management system. So with the general guidance put out by the agencies, what is one to do? Well, use the best available information to interpret expectations and develop a program, or you could just follow the IIA, the Institute of Internal Audit guidelines to build your framework. So let's focus on Fannie Mae since they seem to have been the most public in their expectations for internal audit. The guidelines broadly state that the seller servicer must, quote, have internal audit and management control processes to evaluate and monitor the overall quality of its mortgage loan production and or servicing. That's pretty broad and about as clear as mud to be left to interpretation. But what they did do is provide some clarification in the Beyond the Guide on pages 5 to 6 of what they expect for internal audit. The Beyond the Guide references the IIA, which I mentioned earlier, the Institute of Internal Auditors, which should be used as your framework for building an internal audit program. Prior to December 2016's update in the Beyond the Guide, the only reference to internal audit was either as a finding in a MORA exam or the seller servicer application, where it stated that seller servicers are expected to perform ongoing audits to ensure loans meet Fannie's quality standards. So for those who are unaware of what a MORA is, it's Fannie's Mortgage Origination Risk Assessment. Personally, having reviewed numerous moral findings related to internal audit, it's clear that the 4 items listed in Beyond the Guide, which are also on this slide, are what's minimally expected. 1, internal audit must have an independent reporting structure, something that Tara hit on earlier. 2, you must perform a risk assessment and have a methodology behind it. 3, you must have policies and procedures to detail the internal audit process, govern reporting to senior management, and address remediation of findings, which is very similar to the QC process. The governance for internal audit is found in an organization's internal audit charter, which outlines who, what, when, where, how, and why. The internal audit charter should be approved by the board of directors or equivalent executive committee if you don't have one. And lastly, SANI requires a minimum 12-month audit plan, but typically in internal audit, you develop a 36-month audit schedule. This means that ongoing audits must be performed of the seller service operations and functions to ensure that loans sold to the agencies meet investor requirements. As Tara stated on the previous slide, a one and done is not only insufficient, but also non-compliant. Next slide. So in continuation of why you have to do internal audit, it's a requirement. The CFPB, our most recently rebranded BCFP, outlines 4 pillars of an effective compliance management system. 1, you must have a board management and oversight. Don't forget that internal audit should report directly to the board or board-like body. You must have independence. 2, you must have a compliance program. Internal audit reviews functional areas as a backstop to compliance. 3, you must have a program to respond to consumer complaints. And 4th, an independent compliance audit, which is basically internal audit. In the banking industry, internal audit serves as the 3rd and final line of defense.
There are many different types of risk, which include inherent risk, residual risk, reputational risk, compliance risk, and financial risk, to name a few. Inherent risk is a level of risk prior to controls being put in place. The nature of our business has a high inherent risk. Regulatory changes, previous mortgage crises, housing inventory, and the financial aspect to lead to a higher inherent risk than, let's say, manufacturing artificial Christmas trees where there is relatively stable business environment. Residual risk is a risk which remains after controls are put in place. For example, firefighters have a high residual risk. Firefighters wear protective gear and breathing apparatuses, but still it's a risky business. Reputational risk is loss resulting from damage to a company's reputation in lost revenue, increased operational or regulatory costs. If the CFPB issues a cease and desist to a company, that company will face reputational risk because of it being public, which can result in loss of future business. Compliance risk is exposure to fines, penalties, material loss faced when a lender fails to act in accordance with regulations, policies, and best practices. And financial risk is the risk of financial loss. Any of the previous mentioned risks can result in a financial loss. Internal controls are an integrated part of an organization's governance and risk management system, which is effective, understood, executed, and actively monitored by the organization's governing body, management, and other personnel. To manage the risk within the risk tolerance established by the governing body in achieving the organization's objectives. Examples of controls which can mitigate risk: executing effective and efficient processes, providing reliable information for timely and informed decision-making, ensuring conformance with applicable laws, regulations, as well as the organization's own policies, procedures, and guidelines, safeguarding the organization's resources against loss, fraud, misuse, and damage, and safeguarding the availability, confidentiality, and integrity of the organization's information.
So what does a year in the life of a glorious internal audit program look like? From a high-level perspective, there are 4 key components, which Tara and I will go into detail on the subsequent slides. Step 1, performing a risk assessment. You must start with a risk assessment. The risk assessment methodology is used to identify the operational areas and functions to be audited and the frequency of those audits. The risk assessment is generally completed on an annual basis by the Internal Audit Department to identify the scope of the review and apply risk ratings, such as low, medium, high, to the areas to be reviewed. Based on the results of the risk assessment, an audit schedule will be developed. So step 2. So building the audit schedule. Based on the risk assessment, a 1 to 3 year audit schedule will be put in place. At any time, the schedule could be revised based on a business model change, regulatory environment change, state examination results that may result in targeted audits, or an increase or decrease of risk in a particular functional area. Step 3, you actually perform the audits. Once the audit schedule is established, you begin to audit. We'll talk about what that looks like and give you an example of how one would audit the QC department so you can really see the difference between QC and internal audit. And the last step, corrective action remediation plan. We'll cover developing a corrective action remediation plan to close the full loop circle. It's very important to ensure the loop is closed, as it serves no purpose to identify deficiencies and not self-correct.
A risk assessment is part of a strong internal audit program and should be done annually. The risk assessment generally identifies a frequency of reviews based upon the risk rating applied to the department and functions of your company. Understanding key management strategies and operational areas of the company through employee interviews, questionnaires, review of board minutes, policies, procedures, financial statements, and audit reports. An assessment will consider factors such as transactional volumes, prior CFPB state and agency audit results, QC results, reputational risk, tenure of staff, management concerns, current regulatory environment, and change in strategic objectives, such as getting into a new business model. If a lender will be entering into MSA or JVs, which typically carry more risk, these items should be taken into consideration and weighed. While reviewing audit results, pay particular attention to the severity of audit findings and whether appropriate steps were taken to remedy concerns. During a risk assessment interview, management is often asked, "What keeps you up at night?" Although it is important to get a pulse from management, it is also important to hear the concerns of employees who are doing the day-to-day job. This will give you a complete picture of potential risks. Become familiar with operations and the level of oversight. Attending operational meetings and observing departments through the year will help you refine your audit program and assist in completing your risk assessment.
And from an external auditor's perspective, we're not able to sit in the operational meetings that Tara talks about with her team. So while the external auditor may be an extension of your organization, it's not involved in the day-to-day culture of the organization. We don't attend the company all-hands-on-deck meetings. We don't attend the company barbecues. We definitely don't go to the President's Club trips, although I don't think sales would ever invite internal audit to one of these. And we don't get the benefit of the day-to-day water cooler talk.
Based on your risk assessment, a 12 to 36-month schedule will be created and approved by the board or executive management. This schedule should identify the areas subject to review during the current 12 months, and it should align with your risk assessment. The schedule is not set in stone. Ad hoc audits can be added based on regulatory developments, CFPB consent orders, or self-identified issues in a department. For example, last year, a lender received a CFPB RESPA consent order. Based on that consent order, I'm sure many companies performed an ad hoc RESPA internal audit. Other changes, such as TRID or clarifications to existing rules, may impact your audit schedule. In many companies, if the audit schedule needs to be adjusted, the Director of Internal Audit submits a modification to the Board of Directors or Executive Management Team for approval, so it's documented and memorialized. During the planning stage, the internal auditor will determine the audit scope and objective of the audit by gathering information on the process or the department. Internal auditor is not necessarily an expert in all areas, so it could take some self-education and interviews. The internal auditor will gather information on the important processes, evaluate existing controls, develop a questionnaire appropriate for the department for interviews and discussions, and gather applicable information such as prior audits, regulatory exams, internet searches, regulations, and appropriate manuals. The auditor will learn the department's operation, inherent operational risk, management, and staff of the department perform the operation, and review organizational charts. Once enough facts and information are gathered to develop the scope and objectives, the department manager is notified of the audit and additional documentation is requested to perform the field work. Field work concentrates on transactional testing and informal communication. During this phase, the auditor determines whether the controls identified during the preliminary review are operating properly and in a manner described by the staff. Testing is performed to determine if policies and procedures are followed. To effectively and efficiently review the internal control structure, the internal auditor may observe the department, interview the staff, examine supporting documents, review checklists, develop flowcharts, and perform audit testing. Through this process, the internal auditor will be able to further identify risk, evaluate if the internal control is functioning properly, and identify weaknesses in the structure and process.
So while MQMR's process is similar to CMG's in many ways, we do have slightly different milestones and processes. Our audit process consists of planning, document procurement, where we receive documents and review them in preparation of management interviews, conduct the management interviews, which are typically done remotely, and we have the business units explain what they do and how they do it, and then we conduct walkthroughs, where we gather evidence to compare what is said is being done is actually being done, and in line with the written policies and procedures, if there are written policies and procedures. After the walkthrough is done, we perform transactional testing, draft a report, and then debrief with our clients to go over the findings and observations, which are best practices or items that are out of scope. Our clients have the opportunity to provide management responses, which we then incorporate into the final report.
After the field work is complete, the internal auditor will meet with the department manager or owner of that process during an exit interview. This is a chance for the internal auditor and manager to discuss potential findings or areas of concern before the report is finalized. Once findings are finalized, a report will be presented to the audit department's management team to discuss the findings, recommendations, and draft report. The department manager is responsible for explaining how report findings will be resolved and include an implementation timetable. After the department review is complete, the internal auditor will finalize the audit report, including background information, scope, audit objectives, and recommendations for corrective actions, improvement, and management response. Internal audit distributes the final report with the audited department's response to executive management. This will typically happen during a monthly or quarterly meeting, but the audit department does have access to executive management and, if need be, can discuss critical audit findings and with management as needed. The review will conclude with a corrective action plan report, which lists the actions taken by the audited department to resolve the original report findings. Any unresolved findings will also appear in the follow-up report and will include a brief description of finding, the original audit recommendation, the management response, and the current condition. Let's walk through an example of what auditing the QC function department looks like. The planning stage. You would gather 6 to 12 months of QC reports, Fannie, Freddie, FHA, and VA seller guides and handbooks for QC requirements, more core or other QC audits previously done, and QC policies and procedures of the department. Our scope for this audit is testing against Fannie, Freddie, FHA, and VA requirements. We notify the QC manager of the audit. I prefer to do this by phone and follow up with an opening meeting. Break the ice of the audit, because audit can be a scary word for most folks. Provide a written document laying out the scope, objectives, steps, and timing of the audit. Field review includes testing, review the QC reports for timing, correct sampling size and type. If statistical, does the company meet the requirements for statistical sampling? Are policies and procedures followed? Randomly test 10% of the files to determine if QC was performed correctly. interview, shadow, and/or provide questionnaires to get an idea of the process and test the procedures. By doing this, you might be able to recommend some streamlined steps that could provide an additional value for the company. During the reporting stage, meet with the QC manager to review findings and draft the audit report. The internal auditor will lead the discussion and walk through the findings and concerns. For example, the internal auditor finds that the QC policy states a random sampling of 10% of all files will be QC'd, but discovers during September and October of 2017, only 9% of the files were reviewed. QC manager disagrees, and it is discovered that the auditor miscalculated the loans funded during this 2-month period. Finding is removed and will not appear on the final report. Another example, January 2017 report was due at the end of May, but was not completed until June 15th. Fannie Mae requirements were not met. That will stay on the report, and the manager will have to respond to that finding. Once the exit interview is complete, the report is ready to be finalized. The report will lay out the scope, summary of the department, overall rating, high, moderate, minimal, of the audit, findings, finding rating, recommendations, and management response and timing for corrective actions based on the findings discussed in the exit interview. The report will include the following findings. Finding January 2017 report was due at the end of May, but not completed until June 15th. The rating is considered moderate because it was only 1 month. Internal Audit recommends an annual QC calendar to be created to ensure deadlines are met. Management responds which includes the dates of corrective actions. QC agrees and will supply the calendar within 30 days. After the final report is complete, the report is provided to the executive management team. During testing, it is noted that income was often calculated incorrectly by underwriting, which did not fall under the scope of the QC audit. Internal Audit recommends to executive management an underwriting audit for the next calendar year, or it could be an ad hoc audit if it seems severe enough. After that takes place, retesting will take place to ensure that corrective action is complete. In this case, they were to supply the calendar within 30 days. 30 days we will test to ensure that the timing is met. And then the report will be given to executive management.
So Tara provided some great examples of what she would look for in an internal audit of the QC department. Some common things we identified during our internal audit of QC departments are typically miscalculations of defect rates, no corrective action plans being put in place and are monitored, no clear evidence of the distribution of the report to the appropriate parties, rounding up to 10% instead of absolutely meeting the 10% random selection requirement, and not reviewing 10% of the 10%, the check the checker of the vendor's work if you use a vendor. The key thing is ensuring your QC department is following the published guidelines and presenting accurate information to management to understand the loan quality and any defects associated with the manufacturing process. Next slide.
There are many benefits for internal audit, and although it is not a money maker for the company, it is a money saver. It is better to discover an issue internally instead of having a state regulator, agency, or CFPB discover an issue. Benefits of having an in-house internal audit team are that you are able to build relationships and trust with employees. Your charter allows you access to all documents and systems. You don't have to ask for the documents. You are privy to ongoing communication and existence of standards, ability to perform ad hoc audits, and you're able to take the audits one step further and retest after corrective actions have been put in place.
And the feedback our clients provide is that they appreciate the different vantage points that we bring to the table. Oftentimes, they only get to see their world and how it operates, whereas my team of auditors or any vendor that provides internal audit gets to see many different worlds because they're auditing different companies, which allows a unique approach to each engagement. Just as Tara's mentioned, internal audit is not a moneymaker, but it is a profit retainer. A strong internal audit program identifies not only risks and gaps in controls, but process improvements which could streamline operations, reduce steps in a particular process, or ultimately save money by reducing the amount of time a gap in a control may go uncorrected or unnoticed. It's better to know and act versus find out and react. Identify the problem today and self-correct, rather than sitting on a ticking time bomb of issues that could cost the company lots of time and money. So now what? How do I develop internal audit for my company? There are 3 primary ways to go about it. 1 is to do like Tara did and develop an internal audit department in-house. 2 is to outsource it to a third-party vendor. Or 3 is to take a hybrid co-sourcing approach where you do some audits internally and outsource some externally to a vendor. Typically, those are the areas that get outsourced for audit require technical expertise or areas that your internal audit team may not have experience. Or you could always go down the path of option 4, which isn't listed on the presentation, and that's do nothing. This may save you money in the short run. The long-term result in heartache, pain, and tons of time, and even more money scrambling to get a program up and running once internal audit is cited as a deficiency by a regulator.
So next steps that should take if you haven't done so already, join the Institute of Internal Auditors. Even if you decide to outsource, you should have someone in-house who is knowledgeable about the internal audit process. Institute of Internal Auditors offers many webinars, and most cities have local IIA chapters. Write your charter. An internal audit charter is a formal document that defines internal audit purpose, authority, responsibility, and position within the organization. Choose one of the 3 options above. If you hire internally, staffing is key. If you are able to have 2 employees, then consider hiring one with internal audit experience and one with mortgage experience. Or train your mortgage folks how to be an internal auditor. If you choose the option to outsource, then make sure it's with a vendor that knows audit and mortgage. Traditional auditing is typically done by accountants. If you choose to outsource, make sure they know how to do audit. Secure a seat at the table for operational and strategic discussion. Create a culture where people want to work with internal audit. Most hear the word audit and immediately put up their defense. If you properly build your internal audit team, peers will see internal audit as a value-added partner and seek your help. For example, we had a manager of a new department and he came and asked us to audit his department. Collaborate, connect, and communicate with your peers. Act as if you're trying to put yourself out of business. Merely telling a manager or business unit what is wrong with their department does not do anyone any good. You must suggest ways to improve the process and give vision for the future and be transparent. Okay, Alexa, Siri, Cortana, and Google, now that is internal audit. Thank you.
Michael and Tara, thank you so much. That was a great presentation, lots of good information. We do have some questions, but first I want to see if, Susan, do we have any questions in the chat box?
No, not at this time.
Okay, I have a few questions to go over, and we'll just go through those. Susan, let me know if anything pops into the chat box.
Sure will.
So, Tara, question on the risk assessment. How often should a company perform the risk assessment?
I would recommend annually. I prefer to do mine in November so that the audit can start first thing in January.
Okay, great. So another question would be, if the compliance department performs the internal audit function, is that sufficient?
Technically, no, that is not sufficient because Fannie Mae and the IIA mandate independence. So your compliance department wouldn't be independent from the function being audited.
Okay, so would that mean that internal audit really needs to report to risk or even the executive management, the president? Where would they report?
Right. It should be the president, but obviously the president isn't going to approve their time off and things like that. So in my case, we kind of have a dual role. They directly report for their audit functions to our executive management team, but for day-to-day operations, I oversee that process.
Okay, great. So question for Mike. Are most companies competently able to handle their own internal audits?
So if they've had experience before, yes. I mean, a lot of companies, they go out and find internal auditors that have done audit. And as Tara mentioned, you definitely want to find somebody that has mortgage experience. We often find that, especially on the independent mortgage banker side, the common misperception is that QC is the same thing as internal audit. So short answer, no. I think the agencies are starting to really ask for true internal audit. What do you have in place? Show me your risk assessment, show me your audit plans. And a lot of times those companies don't have a good response other than, let me figure it out, let me go call a vendor right away, or let me put a rec out to go find somebody that can put a program in place.
And Mike, to add to that, sorry, I was just going to add to that. We have been asked, our internal audit manager and our internal auditor, the auditors do ask for their resumes to ensure they know how to do internal audit.
Okay, that's good to know. So in that vein, since many companies may not really be able to handle their own internal audits, what are the costs and benefits of having an internal versus external function?
Yeah, I'll take that one.
Yep.
So we touched on it on one of the slides where Tara talked, hey, we get to meet more closely, or her team gets to meet more closely with her team and the operations and the different departments. So that's a huge benefit that they have, is that they're more closely related, and they have they get to hear what's happening, what's the culture of the organization, what's going on at different events, and they're more intimately involved in the day-to-day. A benefit from outsourcing it to an external auditor is that the external auditor usually has a team of auditors that have a broad and deep range of subject matter expertise that maybe an internal audit department that has one person, because the company can only afford it, they can't go as deep on those particular topics. So that's why sometimes companies will take the hybrid approach. If they're able to have an internal audit internally, a resource, they'll outsource those technical areas to external vendors. And I'll let Tara answer her part.
Yes, I agree with that. So we have taken a hybrid approach in the past, and we will continue to do so. For example, IT is not our strong point, so we will outsource that audit. Servicing tends to be another area where it's different from the front-end mortgage, so we might outsource that audit also.
Okay, great. So since both of you are so in tune with internal audits and this is the overall industry environment, what are some of the trends that you're seeing in the internal audit environment today?
Go ahead, Tara.
I kind of think I might have answered that. So, we always look at our risk. What are the high risk areas in the industry? Right now, it's internal audit. We also have seen a lot of servicers get some scrutiny. So obviously that's what we focus on right now in our area. HMDA just came about, so people might want to audit their HMDA laws and make sure that we're following the most recent requirements.
Hey, Marty, I do have a question from our attendees, if I could add that in before we wrap up.
Sure, go ahead.
She asked, do the agencies recognize smaller firms where people wear multiple hats and allow us to use our own people to audit For example, I'm the ops manager and I also oversee compliance. I report directly to our CEO. However, we've always felt I would not be able to audit since I oversee all of these departments each day.
That's correct. So the individual, he or she can't audit themselves, which is where independence comes into play. And as Tara mentioned earlier, Tara can't audit herself. So to answer the participant's question, he or she can't audit themselves. And so they have to either hire somebody that's truly independent and has no part of any of the day-to-day functions of the operations to audit those areas, or outsource it to a third party.
Okay, great. Well, we are at the top of the hour, so I want to thank Mike and Tara again for being great guest speakers. This was really helpful, and you really drilled down on, you know, the differences between QC and internal audit and all the misconceptions. So thank you again for your time and willingness to be our speakers today. We do want to plug our next mortgage quality and compliance webinar next month, which is July 26th. We're going to be hearing about title and escrow best practices from Jason Goldstein at Bookhalter. So hopefully you can join those. Be sure to let your colleagues know about that webinar as well. And again, we appreciate your time and look forward to seeing everybody on the call next month. Thank you so much. Have a great day.